Hello, party people, and welcome back to the first money news in human words for 2023. There's been a bunch of stuff happening, so keen to share. I hope everyone's had a great holiday break and a great start to the year so far. So, look, the first piece I wanted to share this week was around lifestyle planning and share investing, and this is actually a story from someone we've been working with for a little while that basically implemented a number of tactics that allowed her to create a tax saving of over $20,000 in year one and total upside of $146,000 in just a 12-month period. But interestingly, for this one, the non-financial benefits were actually way bigger than the financial ones. This lady was in her late 30s and was considering taking a promotion that came with a big jump in her income, but also a big jump in her workload. She really wanted to have kids, but she knew that taking this promotion would mean that she had to gun it for a while and essentially delay her starting a family. In her words, she said she wasn't getting any younger. And so that was something that was a really big personal thing for her that she wanted the ability to do. And this planning allowed her to actually do that. So in terms of the numbers, she was 37, her income was $210,000 a year, saving $3,000 a month, and her assets position was $850,000, which was broken down as two investment properties, one worth $700,000, the other worth $800,000, with a $560,000 and a $640,000 mortgage attached to them. Both properties had gone up a fair bit in value, but then they'd come off a little in the recent past. She had cash in her offset of $310,000, super of $160,000, and ETFs and employee shares of $80,000. Now, when we first started chatting, she was frustrated by her big tax bills. She felt that she was doing well, but no idea if what she was doing was enough. She was really questioning her property strategy and had no other investments. She was saving money in an offset because she really wanted to buy her own home, and she was planning to sell her two investment properties in order to fund the own home purchase so that she could do that without having a crippling mortgage. What she ended up doing as a result of going through the decision-making process was the first thing. She came to the realization that she wasn't able to afford to buy the dream home that she wanted and build wealth at the rate that she needed to and not take the promotion. But with making some changes to her strategy, that she could actually get there without taking the promotion. So what we figured to do was that she could invest an extra $210,000 of the money that she had sitting in cash. So keeping $100,000 in cash savings of a nice chunky emergency fund. She knew that that number was a little bit excessive, but it gave her a good peace of mind. The rest of the money was invested. She sold down her share portfolio and then transitioned that to an investment bond with an initial contribution of $265,000. What that did was that with investment bonds, they're actually, if you hold them for a 10-year period, you don't pay any capital gains tax on the gains, and essentially the income earned over that period is capped at a maximum tax rate of 30%. So her plan was that she could crank this investment bond essentially without paying too much tax. And then when it matured, that she would then be able to fund her dream home purchase without having to sell her investment properties and without having to take this promotion. At the same time, maxed out her salary sacrifice contributions and did $25,000 in catch-up super contributions. So because her super balance was below $500,000, she was able to contribute tax deductably to super any amount that hadn't been used from a previous year's what's called concessional contribution caps that allowed her to put in $25,000 and claim a $25,000 tax deduction. So where the upside came from in this one is that she, by not selling her two investment properties, she essentially avoided having to pay $105,000 in sale and repurchase costs on the property, because if she sold the properties, about 2% in selling fees. Then because she knew that she needed to rebuild her investment property, she would have repurchased very similar properties and having to pay stamp duty on the way in. So that's $105,000 saving. She ended up with an extra $400,000 in property investments because she held on to the two investment properties that she had instead of selling them both down and buying her own home, which would have been at a $400,000 lower value. She essentially had $400,000 more property, which meant that using the long-term growth rate on property, that's an extra $25,000 in growth every single year. The extra investment of $210,000 meant an upside of $15,000 a year. Investment bond created $15,000 tax saving on the investment income, about $2,000 a year, and no capital gains tax on the growth. So that's $2,300 per annum. So a total of $5,000 a year. Maximizing salary sacrifice, $1,500, $25,000 in catch-up super contribution, $7,500. Total upside was $158,000. Net advice fees after tax in year one, $8,000. So her net after upside less advice fees, $150,000 in year one. And then that number was actually increasing over time. But obviously $150,000 is awesome money, and she was stoked, but the non-financial benefits to her were so much more than the financial ones, from realizing she didn't need to take that promotion and she was able to pursue the family plans in the way that she wanted to. The next piece that I wanted to cover this week was off the December home price data, which showed that there's been a record decline where the average property price around Australia is now down 8.4% from the peak that we saw on the 7th of May 2022. So off the back of the last 9 months of rate tightening cycles, basically the previous record from peak to trough declines was 8.38%. So it's just eclipsed that at 8.4%. But that's seeming to be seeming that there's a little bit further to go in the property market. Now, that last decline happened between October 2017 and June 2019. So almost a 2-year period, whereas the one that we're talking about at the moment has been seen over just less than 9 months. Now, for the people listening in, yes, I know that not all areas of the country have been affected in the same way. So like for the people from Adelaide and Perth, the prices are still staying about neutral, maybe coming off a little bit, but they also were a little bit behind on the run up in markets as well. So potentially if they follow suit from the eastern states, we're likely to see those declines. But essentially this is for the average property value around the country. Now, not all areas are impacted the same across states. Not all areas are impacted the same within states either, because even though Sydney market is down, we're seeing the outer suburbs are being impacted more than the inner ones, and similarly for other states as well. Now, does this mean that property isn't a good investment? Well, no, in my opinion, although I suppose no one's really got a crystal ball, but the fundamentals are still solid around this. But we've seen the markets come off. I'm talking to a lot of people that are sitting on the sidelines at the moment with property market, and it does remind me about the conversations that was having with people around early 2020, where the property prices had gone down. We were just seeing that COVID was really kicking off at that point in time, and no one really wanted to move on buying property because they'd seen the market coming down. Everyone's an expert at that point, and they're predicting that markets will continue to go down further. If that happens, then people are trying to jump in and swoop up a bargain. Now, what that didn't happen. The markets didn't continue to fall further. What happened was that we saw a massive uptick in property values at that point, and a lot of people ended up priced out of the market. So given that we have seen a cooling, and yes, there probably is a little bit more to go, but if property is part of your future and the stars line up with your strategy now, in my view, that there's a lot of opportunity out there at the moment. The next piece is around some of the data showing that younger investors in particular are exiting the share market in droves. Basically, the data coming out over the last year saw a lot of people stop purchasing ETFs. They saw the older people buying more investments and investing more, but the younger people were investing a lot less. And look, it sort of makes sense that with the increases to interest rates, and we're seeing an increase to the cost of living, that the first thing to go is generally your savings and investments. People say, well, I need more money to cover this expense. And so savings goes out the window. Now, when we've seen the share market that's come down quite a lot in the last 12 months, that means that if you don't invest in the next 12 months, it means that you're missing out on the opportunity to purchase investments at lower prices than you could have purchased them before. And it's a funny thing because when markets are going up, we're seeing a lot of people that are investing, and they're buying while the prices are going high. But then when the prices go down, they don't end up investing so much. And so you purchase up shares up here, but you're not taking advantage to buy them down here. Now, in my view, that I think if you think of success principles for 2023, it is likely to be a year of disruption. It is likely to be a year of higher cost of living. But if you can find a way to balance things, and I get that it's hard, but so you preserve some level of savings and investments, it means that you can continue to build momentum throughout this period of time, and mean that you're going to be way better off when it comes to this time next year. So look, I get that it's not easy, but it all comes down to priorities, figuring out what you absolutely have to do, what is optional, and of the things that are optional, how important are these things to you? Prioritize the things that are the most important to you, and hopefully your savings and investments, is somewhere up there in that list. Deprioritize everything else so you end up saving more. My last piece from this week is around the Tesla share price, and our dear old friend Mr. Musk being the first person to ever lose $200 billion. Basically, we saw that Tesla just came out with record sales of new vehicles at like 405,000 vehicles in the last quarter. But what the share price ended up tanking as a result. And when you get into the detail here, that the Wall Street analysts were predicting that they would sell 420,000 cars instead of 405,000. And when they fell short, they took it as a real negative of the company and the potential for demand. And so the share price has been absolutely hammered. Elon Musk's wealth has been hammered along with it. Now, it's a record that you don't want to be that you really don't want to be making, to be the first ever person to lose $200 billion in wealth, especially after being the first person to ever crack $200 billion in wealth. But that has happened. I think Mr. Musk is playing it cool. How much of that for show, I suppose time will tell. But there's notes about internal communications to Tesla employees telling them not to fixate on the stock price, and reiterating the fact that the car maker is likely to become the most valuable company in the world. But for me, I think the real lesson in this is it doesn't really matter how good a company is or how awesome what they're doing is, that their share price can really be hammered. And I think that when you look at things from the sidelines, it's easy to go, Tesla, they're doing amazing things, seeing Tesla cars everywhere, which we are, more and more people, they've got these big wait lists, and you go, wow, this must be a fantastic investment. But what a lot of people don't realize is that the big investors in these companies are the institutional investors and the banks and the share funds. And they're the ones that are crunching all this data saying, okay, how many cars do we think they're going to sell? What have they actually done? What does that performance look like? Whenever they fall short, they end up getting pumped as a result. And, for that's the real downside with single stock investing, that if you just pick one company, they're going to go through periods where they're a good performance, so long as you choose a good company, but they're also going to suffer through periods of poor performance as well. So I suppose choose carefully, but know that how something looks from the outside isn't really the only indicator of what the share price is going to do over time. Guys, that's it from me for this week. It's great to be back. I will catch you on the next one.